This is The Real Story with Michelle Makori.
Hello, I'm Michelle Makori. Thank you for joining us. You're watching The Real Story, where we go beyond the headlines, beneath the surface, and behind the curtain to uncover what is really happening with money, markets, and power. And the Federal Reserve has finally pivoted. After 5 straight meetings on hold, the Fed voted to cut interest rates by a 0.25 percentage point, lowering the federal funds target rate to 4 to 4.25%. Chair Jerome Powell pointed directly to cracks in the labor market, saying that downside risks to employment have risen. And he admitted that he can no longer say that the labor market is very solid. At the same time, he said inflation remains somewhat elevated. Now, Fed officials penciled in 2 more cuts by the year's end, but Powell called this particular move a risk management cut. Let's take a listen.
The risks were clearly tilted toward inflation. I would say they're moving toward equality, and that suggests that we should be moving in the direction of neutral, and that's what we did today. There wasn't widespread support at all for a 50 basis point cut today. I think you could think of this in a way as a risk management cut. What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
Now, the vote for a cut was 11-1. Newly sworn-in Governor Stephen Moran dissented, pushing for a half-point cut. Meanwhile, the Fed's updated projections show modestly higher inflation next year, even as growth expectations were revised slightly upward for 2026. So the Fed is cutting, but with inflationary risks still on the table. Is this really the start of an easing cycle, or just a warning shot in an economy that is weakening while inflation refuses to die? What does this mean for markets, gold, and silver? To break all of this down for us and more, let's bring in Lobo Tiggre. Lobo is the founder and editor of the Independent Speculator.com, where he provides in-depth analysis on mining and natural resource companies. Lobo has become a very trusted voice for his often contrarian takes on gold, silver, uranium, and copper. And Lobo is also known as the due diligence guy. And Lobo, we expect you've done your due diligence today. Thank you so much for joining us.
Thank you, Michelle. Always a pleasure.
All right, Lobo, let's kick it off with what we heard from Powell. Obviously, as expected, cutting by 25 basis points there. He described the economy as softening, with job growth slowing and downside risks to employment rising, while inflation ticking back up and remaining somewhat elevated. You heard what he had to say. Give us your overall read from today's meeting and what your big macro picture is on where we are right now.
Sure. So jumping right to the bottom line, this is a dovish mood. And yes, it was widely telegraphed. Everybody expected this. But the fact that the Fed is cutting rates, even though inflation, never mind the projections for next year, which are higher, like right now, the trend is a multi-month upward trend. Even in the Fed's supposedly preferred measure of inflation, the PCE, is going the wrong direction. It's really quite striking for the Fed to cut in the face of rising inflation now and projections of higher inflation going forward. So if nothing else, there's a lot of noise and thunder today. The markets went wildly swinging in different directions. I do think that is the takeaway. But what really caused some of the fireworks, though, is that while that 0.25 point cut was exactly as expected, there was a lot more expectations of maybe a bigger cut, or talk about a bigger cut, or more dissent. There were some people, the hawks, were expected to maybe want there to be no cuts. And what we got was unanimity, except for Trump's new guy on the board. Or at least that's what we assume it was. I don't know that they've actually said that yet. So markets don't like surprises here. And I think that's part of the immediate reaction. There was an immediate reaction even before the press conference, because the cut was what was expected, but the way it was done was not. And the dot plot, I don't know if you've seen it, Michelle, it's quite funny. There's all these dots in the middle, which is everybody else. And then there's this one dot like 100 basis points down there. We all know who that is. So that means that Waller and some of the others who were sounding more dovish towed the line with Powell this time. So I do think the markets were surprised by the way that came out. And stop me if I'm going too long, but the other really pivotal moment to me, and this is partly in how you asked the question, like Powell mentioned that there is still elevated inflation and concerns about it maybe going higher. When he said that, and the past times he said that, he said, well, but it's due to the tariffs and that's one off, right? It's not going to stick. Okay, there'll be a little bit of an increase and then the inflation rate will come back down. This time he said, that's what we expect, but there's a case to be made for it not being that way, that inflation, not just the one-time hit, but the rate could continue to go higher. Mm-hmm. And that was when you saw things turn around. That was when you saw the dollar go down, the dollar go up because this was more hawkish, gold go down, the other markets all pivoted too. By the end of the day, the bottom line that I started with, that this was a dovish decision, helped the main indices on the U.S. stocks turn out more or less flat. But it's interesting that the Forex market and the gold market didn't react to that at all. The dollar went up and it stayed up. Gold went down and it stayed down for the day. And I think this one thing that Powell said was the key to that. If you're scratching your head, why, if the Fed is cutting rates and gold doesn't pay interest, so lower rates are good for gold, why did gold go down today? I think this is it. It was a significant change from Powell, from inflation is one off, don't worry about it, to we think it's one off, but there's a risk here that it might not be.
Well, I will remind you that this is the same guy that told us inflation was transitory, right? But I am inclined to agree with
the same guy who said, I don't see no stag and I don't see no inflation, and there he is.
Right. But I do tend to agree with him on this one. I think that we are stuck with some very, very, very sticky inflation, whether he wants to admit it or not. I mean, it's certainly being seen on a day-to-day basis. We've had these conversations before that what the official inflation data is not necessarily a real reflection of what's going on anyway, and we all feel inflation no matter what kind of economic data picture people would like to paint for us. But look, obviously Powell's stuck between a rock and a hard place. That was certainly the sentiment. Lobo, one of the things that has come up recently is this whole idea of the Fed being obviously dependent on data. And that's a point that Powell made again today, that the policy is meeting by meeting, data dependent. But we've had such major issues with the reliability of the data lately, Lobo. I mean, we've had, as the BLS revising job employment data downwards by almost 1 million jobs, by 911,000 jobs. I mean, that also sort of came up. How can we make trillion-dollar decisions on data that is inaccurate or delayed, as he put it, at best?
Right. It was really interesting because he gave that techno answer about the data, but then he didn't really come to any conclusion that was helpful. So the Fed says it's data dependent, but even without the inaccuracies, even without the revisions, when the data comes out, Powell himself said, when the data comes out, that's at its most unreliable. And yet they're making decisions on that. When it is more reliable, that's 2 months, 3 months down the road. So it's backward looking to begin with. And then on top of that, you got to wait a couple months before it's reliable enough. By then, you've had 2 or 3 Fed meetings. Who knows how many might have gone by then? So he didn't really say, so we have to do something different, or we have a formula for adjusting for this. He just sort of pointed it out and then went on to the next question. But you can't just skip over that. If you say you're data dependent, and the data is backward looking and behind to begin with, and it sucks on top of that. That's a technical description there, Michelle. I mean, but honestly, the data sucks. Nobody.
Yeah.
As a longtime skeptic, I think the hard money advocates in our audience, they've been on this camp all. They don't need us to tell us that the CP lie, as they like to call it, is a load of dingoes' kidneys. Maybe it's actually a good thing that the mainstream is starting to question this data. People are all horrified. Oh no, the trouble at the BLS, Trump shouldn't have fired the lady, it calls into question the integrity of the data. I think great that data should be questioned. But back to your point, Powell didn't really address this. He talked about it and then moved right on as though he had given some kind of answer. But there's no answer. What can he do? Actually, let me take that back. I was going to say, what can he do if the data is unreliable? That's all there is to it. But there is other data. Like, why do they use this stupid owner's equivalent rent thing when they could use Zillow, right? I mean, that's almost real-time data. They could even factor trueflation in if they wanted to. Okay, it's not a government statistic, but it's fairly transparent. The formula's out there, the data's out there. So there are modern sources with close to real-time information that the Fed could be using, and they're still using the same BS that they used 50 years ago. I mean, they fudged the formula since then, but the idea is still the same.
Right, and there's certainly room for improvement and room for revision of the data collection, even just to modernize the process, as you say. But to your bigger point, we have 12 guys, or sometimes ladies as well, 12 people essentially making decisions that move the entire global market. And, that's obviously a bigger point of contention for sound money advocates, that this sort of major decision making is in the hands of 12 effectively unelected individuals, not directly elected at least, and that they sway such massive power. But nonetheless, this is a system that we're working with right now. So let's continue to dissect what it means for current implications before we get into the bigger picture of maybe one day we will have an end the Fed reality. This is what we have to deal with right now. And there was a very interesting point in terms of what we can expect for future mandates from the Fed. We talked about Moran. He voted for that 50 basis point cut. He was the dissenting vote, as we mentioned. But here's something that could be a real game changer, Lobo. Stephen Moran, President Trump's pick for Fed governor, who's still keeping his position in the White House, he suggested that the Fed's traditional dual mandate of price stability and maximum employment should actually be expanded into a third mandate. He made these comments before, and that third mandate would be to pursue moderate long-term interest rates. That was according to Bloomberg. So that means that the Fed wouldn't just be setting short-term rates like the Fed funds rate, but would actively step in to manage yields on the longer-dated treasuries, the 10-year, the 30-year. So that's effectively yield curve control coming to America if that happens. And then that raises questions about Fed independence, inflation risk, the future of the bond market, implications for the dollar, implications for hard assets. Before I get your thoughts on this, let's show our viewers what Powell had to say when this third mandate question was posed to him.
We always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Lobo, what's your read on that answer?
Well, a couple things. One is we haven't thought about it that way for a long time. This is actually not new. The Fed has done yield curve control before. The toolbox now is not the same as it's always been. And actually, this isn't a new idea. If you look at the language of what Congress has asked the Fed to do, this idea of the interest rates is in there. But sort of as Powell says, there's a way to interpret the language to say that that's a consequence of what it currently considers the dual mandate. But it's there. You go read it, and I'm not going to quote it because I don't have it memorized. But I've noticed that before, that there is a case to be said that in the enabling legislation, the wording actually does include three ideas, and that's been boiled down to the two basics. But is this really going to call into question the independence of the Fed? Or I don't think so. I mean, if things get to an emergency level, which clearly they're not there. But if you had a 2008 style crash or a 2020 style, flash crash, people were talking about yield curve control then as an emergency measure and mentioning that the Fed has done it before. So Powell says, well, we're not even thinking about that. But if the stagflation became protracted enough and was causing enough pain, and Powell did say, by the way, this was a really interesting admission, Michelle. I don't know if you noticed this, but he mentioned that their tools don't work in both directions. And that's why it's so difficult when their mandates come into conflict, because the tools, work for one or the other. They don't help with both. So that's why they're stuck. This was an admission that they have no way of dealing with stagflation. At that point, they might go to new tools or old tools, very old tools in this case. Yield curve control is not unimaginable, and it might not be a political thing. It might be, maybe an act of desperation. I don't know, but it might be something there that's not partisan. Actually, I didn't see this thing as being particularly Trumpian, as it were. Trump wants lower rates. I mean, it seems almost, childish to say, but it seems true. Like, he thinks like a real estate guy. He's a real estate guy. And of course, low interest rates are great. And he doesn't understand how this moron, late Powell, doesn't get that we're spending all this money on the interest on the national debt, which is more than the military. All that's true. But you notice that keeping the federal government's interest expense down is not part of the dual mandate, or even part of the triple mandate, if you want to go with what you just brought up. So, of course, it matters. But actually, the Fed has grounds to argue that that's not our fault. It's not our problem to fix. Congress should fix that.
Yeah, well, as many of the guests have said before, we're in an era of fiscal dominance, and that is not going to change, because no matter if you're a Republican or Democrat, that is just not a way to win votes. Regardless of what they may say, ultimately, no one's really cutting spending in any dramatic way, even though there were some minor attempts with the Doge, admirable on the surface, but we saw how that worked out. Let's bring it back to gold, right? Because this is what our viewers want to know. How do you see this meeting impacting? And we'll start off with gold in the very near term before we get a longer term forecast from you.
Well, despite today's market reaction, I came away from the meeting with there's nothing but bullish news for gold here. If the very point we started on, like, this was dovish. The Fed is cutting again in the face of high inflation and rising inflation now, and expectations of rising inflation, and is cutting anyway. So, the whole gold doesn't pay interest thing makes it bullish for gold for rates to be going down. That the Fed made this decision says the Fed is going to throw the dollar under the bus, not the laborer. That's bullish for gold. And then ultimately, near-term fluctuations aside, the outlook is inflationary, and that's bullish for anything real, obviously including monetary metals, gold and silver, but also including other commodities and real estate, other real assets.
Expand on the Fed is going to throw the dollar under the bus line.
All right, so we saw today that even just the hint that inflation might stick around more caused the dollar to surge and gold to fall, which makes no sense. If inflation is high, an inflation hedge should go up, right? Arguably, though, well, let me say, gold tends to lead inflation. And we saw this in 2020, right? We had this huge expectation of inflation. Gold goes up, and it takes a year or two before inflation hits 9%. So the fact that gold over the last year has gone from mid-2000s to high 3000s could actually be the gold market sniffing out the very things we're discussing now in advance. And if you recall, by the time inflation was officially recognized to be around 9%, at that point, gold had already risen, and now it's trading sideways. So I'm not saying that's exactly where we are now, but it's interesting to me that we had such a strong move, even while inflation seemed tamer. It was closer to 2% than 3%. Now we're closer to 3% or over 3% by some measures, and headed the wrong way. So the Fed throwing the dollar under the bus, it didn't, the knee-jerk reaction or the algos that were pre-programmed, talk of higher inflation means higher rates, and that's bad for, there was an automatic response, but then there was a hey, wait a minute moment afterwards, I think. And I do think the bottom line here is that the Fed has said when push comes to shove, they're going to side with the labor market. And that is bullish for gold, and that is bearish for the US dollar.
Well, let's get
And
into
I don't
how
know how far
bullish.
down that rabbit hole you want to go, but I think that sums it up.
Well, let's get into how bullish it is for gold. You've had very correct calls on gold in our previous discussions. I believe you called new record highs within a correct timeline on a few instances in our previous conversations. As we know, gold is up over 40% year to date, hitting new record highs, now well over 3,700 an ounce. What's your forecast for next levels here? When do we get another all-time high? What's your outlook?
Okay, I want to be very careful here, Michelle, because believe it or not, gold and silver bulls, I am very bullish. I do think it goes higher. But obviously, when something pulls a hockey stick, it is foolish to assume that the only possible path forward is for it to continue. Trees don't go to the moon. A correction now would be anything but surprising. Now, the fundamentals are there, the money printing is there, and monetary policy aside, as you mentioned, Michelle, the fiscal dominance is fierce, right? The great big beautiful bill, trillions in spending. The Doge cuts didn't happen, so they're not balanced. This is inflationary. And that's not a judgment on the Trump agenda. Whether you agree with the Trump agenda or you don't, that's not the point. The point is it's inflationary going forward. So it almost is painful for me, Michelle, to say, at 3,700 to say, yeah, it's going higher. But for multiple reasons, including everything we just talked about, and we haven't even talked about the central bank buying or the reallocation of portfolios towards gold. That Rick Rule thing, that 2% being the average mean over the decades, and we're only at 0.5%. I think there's pretty strong evidence that reallocation is happening now, that has started. So all of these things are very bullish for gold. The only thing that's not is that hockey stick, right? Mm-hmm. So does the hockey stick mean it can't keep going? No, I don't know how the hockey stick goes, but it does call for caution. And, pride goeth before a fall. It's when we say there's no way, that there's no downside here, that's when downside tends to smack you in the face, right? So the bottom line here is, don't call me a bear. I am bullish. I do think gold and silver go higher from here. It feels like, that's not a very scientific statement, but it feels like gold wants to take 4,000 out. It feels like silver wants to take 50 out. I would not at all be surprised to see that happen before we get a correction. But you never know. So please remember, dear audience, nobody goes broke taking profits. It is okay to have stops in. I have a strategy on this I call the upside maximizer. I don't know when the market tops, but I have math on my side to help me cash out when things start rolling over, so that if I'm wrong in my expectation of higher gold and silver this year, I'm still going to keep my wins.
Okay, well, higher gold and silver this year. I know big picture, you're very bullish on the big picture there, but let's unpack this bear case, okay? Other than the hockey stick pattern, what would trigger what macro triggers, what policy decisions, what global shocks could you see pushing gold down? What would be your bear case for gold not continuing this ascension?
Sure. The bear case wouldn't be fundamentals or anything else. It would just be, in hindsight, a realization that 3,700 was too far, too fast. Right? If all the macro justified, let's say 3,000. Well, that's $700 lower. If gold corrects to 3,000, that would really hurt the gold stocks. It would scare a lot of people out of the market. The irony, though, Michelle, is if gold were to correct to $3,000, that is a phenomenal level for the actual business of mining the stuff and building the mines. The feasibility studies, an aggressive feasibility study today, is modeled on $2,500 or $2,600 gold. Right. And the miners that are actually making money now, these guys are printing cash. They're printing, not printing money, but they're literally making money, and because gold is real money. But, those mines, some of them were built assuming 1,300, 1,500 gold. Like the margins are crazy good right now for the actual business and would be even with a major correction. So the answer to the question is, and here come the rotten tomatoes, Michelle. It could have been today. Like what happened today, the fluctuation today could trigger more stops or could get people nervous and they could start selling and that could trigger more stops and you could have this sort of waterfall effect. It wouldn't need anything else. No fundamental shift. The central banks could still be buying, but just Mr. Market waking up tomorrow and saying, "Oh, gee, that was too high too fast. I'm going to take some profits here. I'm going to protect myself here." That alone could be enough to make this correction happen. It could happen tomorrow as you and I are speaking. It's not a promise. It's not a forecast. It's not what I want to happen, dear audience. All I'm saying is, you risk your own hard-earned cash if you ignore that possibility.
Is there a bottom you feel comfortable calling for gold should markets decide to take some profit off the table, even though, as you just pointed out, all the fundamentals would indicate that they shouldn't? Do you have a bottom or a support line, if you
No,
will?
but I actually think something like a $700 down. I mean, that was just an arbitrary number I pulled out. Even gold could drop $1,000 an ounce, and it would still be a great price for the actual business. But of course, that would cause a great deal of panic. But you know what? I don't think it'll do that. I don't have a bottom, Michelle. The answer is I think a fluctuation of more than a few $100s is unlikely because that central bank buying is there. And we have seen the central bank step in with buying when there's a bargain. Like they're not stupid.
Mm-hmm.
They're not trying to push the gold price higher. They're just trying to go long. And we have seen really over the last 3 years, but with a vengeance this year, that whenever there's a dip, some news like monetary policy news that would normally have been this huge headwind for gold, it dips a bit and this buying comes in. And so I actually think the downside here, the correction here, I would be surprised if it was more than a few $100s.
Okay. So 3,000 as a support level?
That would be arbitrary, Michelle, and I'm not a TA.
Okay. All right. All right. Let's talk about the central banks then, because that's obviously a major component on the fundamental, on the macro, and part of the much bigger conversation that we like to have on this show in terms of what this means on the global stage and for potential monetary resets. And we did have a very significant point, central banks crossing a major line recently. For the first time since 1996, they now hold more gold than U.S. Treasuries. Just one piece of a broader trend, we had a report published by the European Central Bank earlier this year noting that gold has surpassed the euro in official global reserves. We know that record gold buying trend continues from what is reported, never mind what we don't get to know about. The World Gold Council showing that an overwhelming majority of central banks say that they will increase their gold reserves in the year ahead. Look, we've discussed
that
this.
one was striking.
Well, we've discussed this.
I agree. That was important. Go ahead.
Well, we've discussed this before. I mean, you were one of the early ones to point out this big de-dollarization trend, particularly after the excessive weaponization of the dollar by the Biden administration, with kicking Russia off the SWIFT system being a key trigger there. We've talked about how then we started to see central banks buying gold at record levels while ditching their dollar reserve assets and treasuries. We've discussed how the BRICS Plus are creating a growing coalition to move away from the dollar and putting aside whether they're going to some kind of gold-backed, commodity-linked common currency or not, where that conversation is right now. They are trading in their own currencies. They've moved away from the petrodollar. They're buying oil in other currencies. They're creating new payments and settlement systems. So, we have on the one hand the US dollar's legacy role challenged on the world stage politically, again, arguably due to excessive weaponization amongst other factors. And then, as we touched on, we have this over $37 trillion in debt, over 120% of GDP, waning faith in the dollar and in fiat. So give me your take on the big macro drivers here. Do you think central banks are actually gearing up for something?
Yes. And, I'm usually the rain on the parade guy that says, the BRICS are not going to come out with a gold-backed currency tomorrow. I try to be the voice of reason on that. But the answer to your question is yes. I actually believe it is likely that at some point the BRICS will embrace a gold-related, hopefully gold-backed, but gold-adjacent, probably a crypto type thing where they can expedite transactions, but also have something real behind it. And why? This isn't just because I'm a gold bug and I love gold, therefore everything has to be great gold. The reason why is like there's, despite the public displays of affection on TV, there's very little love lost between the Chinese and the Russians. The history there is not one of brotherly love. And I just can't bring myself to believe that Putin and Xi trust each other completely, right? Believe everything each other says, right? No, of course not. And beyond those personalities, China and India, they're in they're in somewhat open conflict over their borders, right? You have those skirmishes where they fight with sticks and rebar and stuff along the border. Like, there's not a lot of love lost there either. So the point is, if you're going to move away from the dollar, you're going to replace that with the ruble? Heck no, right? Are you going to replace it with the yuan? Well, maybe the Chinese would like that, but the Russians aren't going to go along, and why would the Indians either? Gold actually provides a neutral alternative. And it's something that you can verify. You can actually send inspectors to the vault and see if the gold is there. So if you have a system that all of these countries embrace, and the gold is deposited around, not just in one country, but in multiple countries, and they have a treaty right for all of them to trust but verify, this actually makes a more viable alternative. Let's rewind the conversation a little bit. So I can see this happening, and I think that it's actually likely, as this experiment that governments of the world have embraced in fiat currencies, calling paper money over the last 100 years, that I do think eventually unwinds. But that doesn't mean tomorrow. Mm-hmm. It actually, my belief that this is likely to happen is not part of my investment outlook right now at all. It makes no difference to what I buy or what I trade. I think the next big thing is actually copper, not gold. And we've talked about that before. I don't know if we can come back to that. But my point is that I can believe this. Not only is something that is likely to happen, but it's a strong probability. I think this will happen at some point. But it's the sort of thing that takes years to develop. At the very best, if they announced that they were going to do this today, I think it would take easily 5 years to implement. And we're not there. So I'm not buying stocks today, even gold stocks, because of what might happen 5 years from now. That's just too far away. Too much can happen in between. So for people who like to believe that, the gold is going to come back into circulation and replace the dollar as the world's reserve currency, I'm with you, brothers. But it doesn't affect my investing decisions today.
Right. And in terms of laying the groundwork, Andy Schechtman and I have had some very, very detailed conversations as to how that's happening, how gold-linked payment settlements are being set around the world, predominantly led by China, how the financial architecture has been really laid out with, as you say, a combination of a digital token as well as new ways to bypass a SWIFT system. We've had this conversation in length, and I know that's not your department. I urge our viewers to take a look at some of my interviews with Andy Schechtman, where he really makes the case. Yeah.
Yeah, no, it makes sense. My only caution to readers is don't interpret that, or don't take that to mean gold's got to go to the moon tomorrow. I mean, do you remember, Michelle, it was not 24, I think it was 23, August 23, where there was a BRICS meeting in South Africa, and the Russians had leaked, of course they love to destabilize everything, right? They had leaked that a gold-backed BRICS currency was going to be on the agenda for that meeting. And people were betting, people were making investment decisions based on the fact that August 24, 2023, if I'm remembering correctly, the BRICS countries were going to announce this, right? And I had readers writing in to say, Lobo, what's the plan? What should we buy for when the BRICS announce this? And guess what? It didn't happen, right? So I'm just saying, don't drink the Kool-Aid here. Don't get too enthusiastic. The inevitable, as Rick Rule likes to tell us, is not always imminent.
Right. What is inevitable is not necessarily imminent, but it does feel, Lobo, as though that timeline is getting closer. and closer, and as though things are accelerating at a more rapid pace. We'll
I
put this
agree.
out. We'll put this out.
Sorry, let me just jump in with one more point. I
Go ahead.
think, it's starting to accelerate. The curve is starting to roll over for the dollar. When it really starts, when that slope starts steepening, I think we'll have pretty clear signs. There won't be that much debate. Okay, maybe mainstream economists or Fed economists, they'll deny everything until the end. But independent thinking people out there, I think we will not really be debating it. Right? It will be
What would
obvious
that
that
sign be? What would that sign be to you? What would be a definitive sign to you that, okay, it's here, it's now?
well, here now not, but accelerating to the point where becomes an investable thesis, it would be a remarked uh, a marked acceleration of the decline of the dollar. Like, people got very excited when the dollar dropped below 50% of global reserves. Like, oh, somehow this magical number meant the dollar was done. It wasn't done, right? 47%. We still have contracts, international contracts settled in dollars. We still have the euro dollar system. Global debt in dollars. So see, the thing is, when the dollar was 50%, it's not like the euro was the other 50%, or the yuan or gold or anything else. It was the dollar at 50%, and then half a dozen other contenders with small fractions. And so even at having dropped to 47%, the dollar is still head and shoulders above everything else, including gold, the euro, the yuan, whatever else you want to put up there. The dollar is still far and ahead away. So I guess what I'm saying, so like, it's been declining for decades. It's been, with volatility heading lower. When that rolls over, when we see a change of slope, then I think that's a signal that it's time to start actively preparing for a regime change, currency regime change.
You're a speculator and a trader, and I know it's more short-term speculation, but what is your speculation about a potential gold revaluation coming from the United States? Because some theories are that the U.S. is aware that this is happening, this global monetary bifurcation is happening, that the other countries are gearing up to launch some kind of gold-linked settlement layer, settlement currency, whatever you want to call it, and that they may beat them to their own game. And there have been some signals that the U.S. may be looking at that, including a Fed policy paper looking at how other countries have revalued gold. Trump's inner circle, including his own son, has said that it could happen. And again, we've gone into the details here on various other shows, which I'm happy to repeat again, but I have a feeling you're familiar with all of this. There have been a lot of indications that this could happen, and potentially within this administration. As a speculator, is this something you are considering in your strategy? Is this something that is on your radar for a nearish term occurrence, shall we say?
I understand the question. As a speculator, no. As a human being watching things, sure, it's on my radar. It's something that I think about. But this is a binary outcome, Michelle. If this happens, the moment that's announced, it's like FDR freezing things and then revaluing the dollar 50%, right? It's too late at that point. They've already closed your bank accounts. You have to have a police officer and a bank officer to go into your so-called safe deposit box, right? When it happens, it's too late. And if it doesn't happen, it doesn't happen. So it's not like a trend. This is not like the dollar rolling over, right? Where we get to a critical change of pace. This is something that just doesn't happen, doesn't happen, and then suddenly happens or not. That's not a trend. There's no data points that tell us, oh yeah, it's about to happen now. So I think it's interesting. I have to say, I think it's probably unlikely. Besant said he didn't like the idea. I mean, it's amazing that they even talked about it at all. The problem is, like, yes, okay, if you revalue the dollar, if you revalue the US's gold holdings, assuming they're there, assuming the gold is actually there in Fort Knox and other repositories, and you mark it to market, you can boost the government's balance sheet by $1 trillion, they say, something like that. Great. But $1 trillion, that's just a part of the Fed's balance sheet right there. And if we're 37 trillion in debt, and never mind the unfunded mandates, right? This is It's kind of de minimis. So I'm not saying $1 trillion doesn't matter. That's real money, even in today's world. But the price of revaluing the gold is, in marking it to market, is an admission that the dollar is worth so much less. You're going from 42 bucks. It's on the books at 42 bucks. To go from 42 bucks to 3,700, that's an almost 100x devaluation of the dollar. I just, it's very
Well,
hard
Lobo,
for me to
that's why
see.
those that see that theory think that it'll be revalued at a much, much higher rate, not at market price. I mean, that's part of the theory. As far as Treasury Secretary Scott Bessent, he has made comments that they are going to monetize the asset side of the balance sheet. Then when he was asked about it, he kind of walked it back. Then he kind of walked
He
it
said it wasn't
forward.
my idea.
He said he's not looking at it, I believe it was something like today or in the near term, but he has hinted that it could happen. So we're kind of interpreting his words.
I hear you, Michelle.
I don't
And
think
it
there's a
could happen.
definitive.
I am
I
not
don't.
saying it can't happen. I hear you. All I'm, you asked, and I'm telling you, I think it's unlikely because I think it's too great an admission of
It
the
is.
failure of the fiat experiment. You revalue gold at $50,000 an ounce. Great. You can wipe out the whole, or not whole. You can wipe out a third of the national debt. Wonderful. But the cost of doing that is basically telling the world, our little green pieces of paper were worthless all the time. I think that shock would go beyond the United States. I think that doing that has the potential to cause this financial house of cards to collapse that we've all been, ever since 2008, we've wondered, how can they paper this over? When is the house of cards going to come down? That revaluation could be the kick in the house of the pants of the house of cards to make it come down. I just personally, I think that's unlikely that they would do that on purpose. I may be wrong, but that's my hunch.
Okay. Well, again, Andy, as well as some others that we've spoken to, think that could be the plan in order to save the treasury market, have treasuries linked to gold, sacrifice the dollar to save the treasury market, to save the system at large, weaken the dollar, help with the whole overall agenda of onshoring manufacturing, making the United States independent and sovereign and not relying on other countries. But again, that is a conversation that we have had at length with other guests. I was just curious to see if it factors into your investment thesis, knowing pretty well that I didn't think it would, but always like to get your thoughts on that. So what are you willing to say in terms of sort of a gold forecast that you are comfortable giving on the upside? What is your bullish case for gold, putting aside those bigger picture, we'll call them more fanciful macro potentials?
Doug Casey told me never to say what will happen and when it will happen. But I said earlier, so the answer is I do have my feeling, my wolf whiskers, if you will, since it feels like gold wants to take out 4,000 and silver 50. The last time I felt this way was on the way up to 3,000, and I was right. So for whatever that's worth. But I have to say, the time before that, I feel, despite my cautions, and it's just not my style, as you know, Michelle, to say buy, and I don't want to be leading the herd right off a cliff, right? Mm-hmm. So I'm always going to be cautious. But the honest answer to the question is, I think we're going higher. It feels to me like gold wants to take out 4,000, which alone could make it, flavor the day and make it go higher. We'll see. The last time I felt this way, I was right about gold taking out 3,000. But the time before that was back in 2011, where I was sure that all the crazy things that governments had done in response to the global financial crisis would take it higher. And I was dead wrong for 5 years almost. So I have to be honest with you, my feelings don't have 100% success rate.
Well, but some of your, due diligence and data does. And to your point, yes, we've kicked this can down the road. So there's really, the precedent is to think that it'll continue that the road will be extended for a little bit longer. So let's talk silver then, because that is something that, by your thesis, still has some room to run. I think you said that there's not a lot of resistance between here and $50. You just said it now. Silver's hit fresh 14-year highs. What's your read on silver at the moment?
The short answer is, like I was just saying with gold, my feeling is it wants to take out 50. That's not a very scientific
In a
statement.
year, in a month, by the end of the year?
In the quarters ahead. Like this isn't a some way, some when. I don't want to say by December 31st.
Mm-hmm.
That's one quarter and a bit. But not a year, not a month, somewhere in between. At the rate we're going, it could do it by the end of this year. Both 4,000 and 50 could be taken out by the end of this year. The rally, I mean, it's been ripping higher. And okay, today as we're recording, there's a little bit of a wiggle. But those happen. Nothing goes in a straight line. So the things about silver that make people love me and hate me are, it is a monetary metal. It does track gold. The correlation is still very high. I'm bullish on gold, therefore I'm bullish on silver. But it also, undeniably in my view, at least if you're going to look at the facts, the data, the silver's industrial side is stronger than ever. Last week, we had gold go over 37, silver go over, silver hit almost 43, and then it did this week. But those happened not at the same time. Gold moved up more earlier in the week, and silver kind of lagged. Later in the week, gold traded sideways, but silver moved up, and guess what? So did copper at the same time. So I see a lot of evidence in the price action in the markets that silver's industrial side is a very, very powerful driver. It's not just a monetary metal. And people get mad at me for saying this because silver is the word for money in many languages, in Spanish and French and so on.
And Hebrew. Yeah.
But I don't actually see this as negative. I'm not making a bear case. I think that silver's industrial side gives it more upside than gold after the safe haven demand cools off, because then you have the industrial demand, you have the solar panels, the electronics, medical uses. There's so many things that can keep silver going higher when there's less safe haven demand, which is a headwind for gold. So the overall outlook, Michelle, is, as we said before, inflation is my broad outlook that's bullish for everything real, including gold and silver. But in that reflationary boom where everything is going off again, silver has more going for it than gold. And on top of that, gold is well above nominal highs and silver isn't yet. So it is a relative bargain compared to gold. So you look at it, has more ways to win. It's relatively cheaper. Of course, I see more upside on a percentage gain basis in silver than gold. Now, the caveat is that doesn't mean it goes straight up for here. If I'm right about more economic turmoil as the tariffs work their way through the real economy, which is my near-term expectation, that is near-term a headwind for copper and for silver's industrial side. Now, whether the monetary side is more important or the industrial side is more important, I don't know. We'll have to see. But I think it pays to be cautious. And if as we were saying before, nobody goes broke taking profits.
So on the industrial side, let's unpack that a little bit, Lobo. It's interesting because the U.S. has updated its critical minerals list, and silver has made the cut for the first time. And critical minerals defined as non-fuel minerals that are vital to America's economy and security. And this is a bit of a turning point, putting silver on the list. Washington is signaling that it sees silver as strategic, part of a broader push to reduce import dependence, as we talked about, lock in secure supply, stay competitive in the global race for critical resources. So that's obviously a positive on the industrial side. But then you've also said that you're seeing stagflation, so slowing down economy, increased inflation.
Right.
How does the slowing economy then, which you are forecasting, how would that impact the near-term industrial demand for silver and reduce some of the near-term upside here?
Well, the way you framed the question almost answers it itself, Michelle. This is why I'm saying I'm cautious about the silver breakout. It feels like it wants to take out 50, but I see more potential for correction. We aren't at that moment yet that, I was going to say something impolite, that oh beep moment where people realize that these tariffs really are having a serious impact on the economy. Now, maybe they won't. Maybe I'm wrong, but right now my expectation is that the real world impact of the tariffs globally and in the US has yet to really be felt in earnest. And when it does, and when people wake up and say, oh, beep, I think that's going to be bearish for Dr. Copper, bearish for oil and energy, not uranium. And that is going to be a drag on silver. And as I say, now whether that drag is greater than the monetary and the safe haven demand pushing up, I don't know. So I would expect copper to go down more than silver, but I would expect this to be a near-term potential headwind for silver, which, if it happens, I think would be an absolute gift. I would be out there wanting to double down on silver stocks in my portfolio, because longer term I think it goes higher. The question is not whether I'm bullish or not on silver. It's just the nearest term, which is your current question. So my answer is I don't know, but I don't want to assume that silver can't correct because of its industrial side. If it does, I'm prepared to double down. If it doesn't, I already own silver, so I'm not missing the boat.
Well, look, and again, investing is all about timelines and timing, right? So you can have a very long-term bullish outlook. And if you're prepared to just sit and hold that investment without taking any action, it'll pay out. It depends on what your sort of trading strategy and your investment strategy is. Let's focus more on this monetary angle, because I do think that there's some interesting developments there, including the Saudi central bank moving into silver. We saw some SEC filings showing that over $30 million were invested in the iShares Silver Trust, another $10 million in a silver miner ETF. This could be a sign that silver is being remonetized. Others say, well, no, it's not the central bank. It's the Saudi Sovereign Wealth Fund, and that's just a sovereign wealth fund play. But how would you read this move? Because, you've also got Russia earmarking over $500 million for precious metals for the first time, explicitly adding silver to its reserves. China, India also moving into silver. China's been buying a silver directly from miners in Latin America, bypassing Western pricing. India's been quietly stacking some silver. So on the monetary side, do you see central banks now potentially looking at silver as a monetary asset as well?
No.
No?
Not really. A lot of the countries you mentioned, China, India, it would be very difficult to make the case that that's a monetary move, especially China. They're consuming a lot of silver. They're one of the, if not the biggest producer of solar panels in the world. So it would be very difficult to prove that their increased consumption or imports of silver are based on monetary issues. The Russians, I think the Russians have a great incentive to rock the boat and do or say anything that would sow confusion amongst their enemies or opposition, if not enemies. So it's hard to put too much weight on that. And yeah, a sovereign fund moving into silver. Even Warren Buffett bought silver at one point, not because he thought it was money, but because he thought it was cheap and would go up. So I don't want to completely rain on the parade here, but remember, Basel III includes gold, but not silver. And if the world was changing, I think we would see that change.
Okay. Let's talk about what we're seeing in the mining sector, because whether it's gold or silver or copper, we have been seeing the miners do very well. And let's bring it to this news that we got. Apparently, reportedly, the U.S. is in talks to set up a $5 billion mining fund. Now, this is interesting because it could be the beginning of a trend here, and it sort of feeds into this whole critical minerals list and this whole idea of onshoring and sovereignty. And if this does happen, this is not confirmed yet, but it would be a huge move into deal making to secure critical minerals. The International Development Finance Corporation reportedly is working on a possible joint venture with Orion Resource Partners. That's a New York investment firm. The talks are still ongoing. Details are being hammered out, and this is according to sources close to the matter. But the Trump administration has made it clear that it wants to lock down access to minerals like silver, like copper, like rare earths, and that's really the thinking behind this potential partnership. President Trump wanting to reduce dependency on other countries and global supply chains. So if this Orion partnership is finalized, it would give Washington a direct vehicle to strike big mining deals itself. Now, granted, it's $5 billion, which in the grand scheme of things is not that much. But what does this mean for the mining sector as a potential trend? Is this a positive? Could this be a healthy boost of investment? What's your read on this?
Two things. One is, even in the mining world, $5 billion, that'll pay for one medium large copper mine. Not even, the big world-class copper mines are more expensive than that to build. So I'm not poo-pooing it. I'm just saying, on the big scheme of things, $5 billion isn't that much. Now, if they're thinking more forward, we don't know yet, because as you say, this is still unconfirmed. There's no details. If they're not, if the idea isn't, we're going to pay to build mines. If the idea is we're more forward-looking we don't even have the discoveries. The pipeline is dry. So we're going to encourage the explorers and developers to advance assets. Then $5 billion is a much more significant amount of money. On the exploration end, as you know well, most of these companies are sub 100 million to begin with. And they're still considered small caps or micro caps, even when they have a deposit that they're advancing. So $5 billion would go a long way to encourage exploration. Production, not so much. But either way, you know what? It's certainly better than the opposite. It's certainly better than not in my backyard thinking. And if you think about it, Michelle, actually, it would probably be possible to go back and look at some of our tapes from your previous employers that we won't mention. And we talked about NIMBY thinking and how it seemed like that would never go away. And I remember saying that at some point, people will realize, we've got to have the metals. You can't produce these things out of thin air. If you don't mine it, you can't recycle more copper into existence, right? So at some point, not in my backyard thinking had to give way to the reality. And if you're going to need critical minerals, you got to mine them. And that is now the world today. It's certainly in the United States, this $5 billion is just one example. As you say, the critical minerals list, including silver. And by the way, that was in a Trump executive order, and a previous one a couple months earlier had included uranium, which the USGS excludes because it's a fuel. It also included gold, which isn't really an industrial mineral, but Trump likes it. So, it's really interesting. The United States government under the current administration could scarcely be more supportive of mining in the United States. And the instant knee-jerk response from a lot of people is, well, okay, but Trump might be voted out in 3 years and it all goes away. Well, if you're an explorer right now, 3 years is a long time to drill something, define a deposit or make the discovery. Or if you're a mine builder, if you've got a shovel-ready project and now instead of looking at 10 years for a permit, you can get it in a month, that's a game changer. And you can build that mine before there's a change of power. And at that point, by the way, not only is the mine already built, so the hole in the ground is already there, but that's also a bunch of jobs that if you're going to shut that down, you're going to unemploy a lot of working class people. So it really changes things. I think, there's a lot of people who, let's just say, hate the United States for a number of reasons, including Americans. I'm not here to say I'm loving or hating the United States. I'm saying this is an investable trend. This government's support for mining in the right companies, in the right positions, is material. It matters. It is a positive for the investment thesis for the right companies. I think that's the main takeaway. The $5 billion by itself isn't a big deal.
Right.
But as the vote of confidence, as you could not have a clearer message from this government that we're here to support mining. And that does matter to me as a speculator.
So let's take that into a step further. What does it mean for you in terms of the mining sector at large? Miners have had a very strong run, up over 100% year to date. What's your outlook?
Well, that's the gold miners, not all of them, but okay.
Right. So give us some insight on the mining sector, some mining equities. I know you don't like to give away particular picks, but share what you will.
All right. Just real quick, I also want to say that I just said that the U.S.'s stance could scarcely be more bullish for mining in the U.S. But the US is not exceptional to that. Europe also has a list of critical minerals, and they're starting to throw money at projects as well. There's some on a fast track list. Of course, fast track by European standards is nothing like Operation Warp Speed, but Canada also has a list of projects. So this is, and of course the Chinese, they never had any problems, pushing for mining. So um, this is a global phenomenon, and I think it's, broadly speaking, as a person who invests in natural resources, energy, and mining stocks, it is striking and important that all this ESG nonsense that was like choking off our industry has now, if not gone into reverse as it has in some places, the tide has shifted, and that's very, very positive for our investments going forward. To your Sorry, ask me again the other question that I diverted from.
If there were any particular miners that you care to
Ah,
share insight on.
okay. Well, how to play this then? So obviously, developers in places that have shifted, if there were places where you really were having troubles getting permits before and now you can, anybody that's been waiting on a permit, that becomes a really interesting speculation, because the project's there. Now you get the permit, and that is a material change, right? So if you have the project ready and the money already to build it, and now you get the permit, that's even more of an instant reward. In terms of where I'm investing now, it's kind of commodity specific at the moment. I'm pretty much long gold, silver, copper, and uranium, and that's it, because I do think that we are going to see near term more of an economic hit. So that rolls out oil and iron, or nickel, certainly lithium, everything else I think is at risk. So it makes my life easier, because I really only need to worry about 4 minerals at the moment. That's my focus. Another thing in terms of where to look, I've just said, if you can see a project going from unpermittable to permittable, that's an interesting speculative investment thesis. If you see a project moving into the pre-production sweet spot, that's always of interest to me, and we have examples of that ongoing right now. If you have the earlier stage, as long as the metals don't go into reverse in the earlier stage, I'm really not one to bet on pre-discovery exploration. I understand that I give up a lot of the
Right.
potential gains there, but the problem is nobody knows who's going to make a discovery. But between the discovery hole and the boring engineering phase of building the mine, there's a lot of value added in between.
But
That early
you're
part of
not
the
looking at
cycle.
miners specifically yourself right now, is what you're saying. You're looking at the commodities as a
Yes.
straight play. Okay.
Well, generally, yes. So I like in the early part of the Lassonde curve, post discovery, but before the boring engineering phase. That first part of the Lassonde curve, that's actually a year or two in most cases, and there's a lot of money to be made when somebody is drilling off a valuable deposit. I love that. I also like the pre-production sweet spot, as you well know. Those are all pre-miners, but I will, in a sort of barbell sense, I will go with some of the go-to names in the space, just because they're relatively low risk. They've done well. I mean, if the GDX, not the GDXJ, but if the GDX has doubled this year, that tells you that, even the biggest miners in the space can give you, 100% gains is a lot. That's an extraordinary gain in such a short period of time for large companies. So in a bull market, I'm willing to buy, some of the best in the space, just as that barbell anchor to balance the risk in the junior end that I embrace.
Okay, Lobo, we're running out of time here, but I need to get your take on copper, because you have said that that is one of your top conviction plays, as well as uranium. But very quickly, let's start off with copper. You've said it's a must-own asset. I'm curious, though, what the factors there are, why you think it's a must-own asset, especially if you're potentially seeing a slowing economy. So break that down for us.
All right, so the quick version is the overall outlook here that we've started and worked into this conversation from the beginning is inflationary. My outlook is inflationary. That's good for real things. That's good for copper. Copper also benefits just from demographics. The world's population is still growing. Everybody needs copper if they want cars, houses, basic things. This is not an EV story. It's not an AI story. It's just a human story. And the difference between this and lithium or oil even and other minerals that we've mentioned is that copper is supply constrained. There's just not enough copper mines as is, even without any extra tailwinds. So that makes me, other than in the near term, because of Trump shock, other than the nearest term, it makes me extremely bullish going forward. And the supply constraint side is really the killer. Like copper cannot be substituted in most of its key industrial uses. So I just love that. And I love how long-term that is. But I am looking for near-term correction, and I'm saving money right now. Like I have a sort of a pre-shopping list in my portfolio of copper stocks that I'm saving up money for. And if I'm wrong, Michelle, and I don't get this buying opportunity, I'm just going to buy anyway, because I'm looking, I think, at a multi-year, possibly multi-decade bull market for copper. And that will be very good for the copper stocks. But I think I'll be right. I think I'll have a chance to buy lower. And so I've got dry powder. I'm banking up for that.
All right, let's touch on uranium quickly. I think it's finally in a structural deficit. So give us your outlook there. I know you've had a long-term call on uranium.
So the quick version there is, the longer-term picture is somewhat like copper. Uranium is less scarce. Eventually, I think it's less supply constraint. There are a lot of known uranium resources out there that aren't even being developed right now. And high prices will cure high prices. But to get there, I think we will need higher prices. And the short version is uranium, I do think it got ahead of itself. It went screaming up over $100 a pound. I got Rotten Tomatoes thrown at me for saying it was likely to correct. Lo and behold, it did. And now it has visibly carved out a bottom. It's heading up again. And I think that has legs. And the one special thing about uranium is that if you look at its track record, uranium, since it's used for nuclear energy, which is base power, it's not discretionary, right? You've got to have your airports and your hospitals have to have electricity. And that's what nuclear power is best at. So uranium prices have actually been recession resistant in the last 3 or 4 recessions. And the fourth one was actually uranium was correcting in 2007 before the GFC hit in 2008. So arguably that had nothing to do with the recession. So I'm cautious about moving into industrial and energy minerals before this near-term shock that I'm worried about. And everything except uranium. Uranium is the one exception. The only problem for me, Michelle, is that the bull case for uranium is so strong and so obvious that the stocks, at least the better ones, the companies that actually have something, they have resisted gravity. They did not correct as much as uranium did. So I already own uranium stocks. I don't want to average up, but I'd like to have more. So my conundrum right now is just not wanting to overpay. And I'm hoping there's another fluctuation in the market and I can buy more. But if I didn't have uranium stocks in my portfolio today, if I was in the audience and I was hearing this for the first time, would I buy uranium stocks today? Yes, I would. I would look for at least a finger in the pie here.
Any particular names that you can share?
You can try, Michelle. But think about what I told you before, barbell strategy. There aren't a lot of uranium names on the larger, more, lower risk end to balance some of the exciting juniors out there. I think that's a pretty good hint.
You will not even give a single stock pick. You want people to sign up to your newsletter. You gotta give something, Lobo. You gotta give the audience a little bit to play with here. Well, I mean, those are some pretty obvious calls.
I hear you, but I think it's better to teach a person to fish than to give them the fish. And I think, frankly, it's unfair to the people who did pay for that information to give it away to other people. So I just don't go there.
Okay. Well, as we wrap up here, Lobo, give me your highest conviction point, a call that you are comfortable saying, this is where I think things are definitely going, without the hedging, without the maybes. One point that you can say with certainty.
Early bird warning, Michelle. I think copper will be my highest conviction trade for 2026 again, or as well. So that is a forward-looking statement. I'm so convinced of this thesis, and unlike gold and silver, which have already gone up so much, and uranium, I believe everything I just said, but it's not cheap the way it was at $18 a pound or something like that. I think looking forward, copper will be the stuff that will make fortunes for people who can handle the volatility along the way.
Copper will be the stuff that will make fortunes for people. That's a bold statement, Lobo. We're going to leave. Yeah, we're going to leave it there. Where can people find you? Tell us a little bit more if people want to learn more about your work.
IndependentSpeculator.com. We have a free weekly letter. It's posted now. We used to send it as an email. It's posted now on the website, so you do need to sign up for the website. I promise we will not spam you with a flood of advertisements if you do that. You get one notification a week. And if you like the way I think, you might consider hiring me as your due diligence guy via my paid publications.
All right, Lobo, thank you so much for sharing some of your due diligence with us. Really appreciate it. Always enjoy speaking with you. Lobo Tiggre, thank you.
Thank you.
And a big thank you to you, as always, for watching. Make sure to subscribe and hit that notification bell so you know when our next video drops. Please follow us across all social media. And as always, we love hearing from you. So make sure to praise, whine, or just opine. Leave your comments. We do read them and we do respond. For me, Michelle Makori, and the rest of the team, we will see you next time. In the meantime, stay sovereign.
This is The Real Story with Michelle Makori.